What's going on? Alex here, and today I'm answering your questions from the YouTube comments. That's right, you leave your questions, I answer them in a video. It's a beautiful thing. And today's question has to do with the mark-to-market election available for traders of securities. This is also known as the 475F election, and let's take a look. This question comes from Jeffrey. Thank you so much for your question. And Jeffrey asks, can you do a video about what kind of deductions/credits are reasonable for a business that trades stocks and only has yourself as the only employee? Interesting. All right, so we have to first define a few different things before we move forward with this conversation, because specifically we want to understand the definition of a business. All right, so businesses are great, right? You make money, you have clients, and life is beautiful. But what can happen is that a business can be subject to self-employment taxes, or a business can be subject to corporate taxes. So that is one of the downsides associated with having a business. All right, so we want to take a look at that in detail and be careful that we don't subject ourselves to taxes that we may not want to be subject to. On top of that, when you are working for yourself, the question is, are you going to be eligible to be an employee of your own business? That's a different question. It has to do with kind of the structure that you put in place and what your goals are. So let's back up. If you engage in a business of trading securities, which means you're doing it on a continuous, ongoing basis with a profit motive, and you have a significant amount of activity in this regard, and we're not talking about 3 trades a year, we're talking about significant amount of daily activity, a good number of trades, you're doing it continuously. This is not something that you dabble in once a year, all right? So assuming you meet that parameter, you have some options available to you with regard to how you want those activities treated from an income tax perspective, because the default treatment is that you are an investor just like anybody else who's trading securities in their Vanguard or Fidelity account. You're no different than that by default. So on the upside, you're not being subject to self-employment taxes or anything like that. On the downside, you are subject to the limitations inherent with capital gains and losses. One of those is the $3,000 limitation in terms of the deduction against ordinary income, for example, wages. If you have a year in which you have significant gains, that really doesn't matter. But if you have a year with losses, then you are going to be limited to that $3,000 per tax year of a deduction. You'll have to carry the rest of those losses forward to future tax years. So not very attractive, because you can have significant losses but still have pretty significant tax obligations for a particular year. So there's that $3,000 limitation. That's one downside of the default treatment that you can get as a trader. The next downside has to do with the fact that any watch sales, and I'll define what that means in a second, that you come across throughout the tax year will further disallow any losses. What do I mean? So if you purchase and then sell, or if you sell and purchase a security within a certain amount of time, then essentially any losses that you incurred from the sale of that security would be disallowed and instead added to your basis to be used once you sell the security. So if that happens, you're not going to get the benefit in the current tax year of those losses. You're going to have to wait till you sell the security in a subsequent year in a non-wash sale transaction to actually benefit from the losses. So just like the first $3,000 limitation I talked about, you also have the wash sale limitation that's further limiting the deduction of losses. So not very attractive in that regard. So those are two significant downsides of the default treatment that traders of securities get. So what do you do? It's a great question. You do have a tax treatment available under the tax code, and that is the mark-to-market election. All right? And the tax advisor has a wonderful article on this, and I'm going to link it down in the chat there for you guys. Check that out. And essentially, they describe this election, which is made under Section 475, specifically 475F of the Internal Revenue Code. Now, this is a whole lot of text that I'm going to break down for you guys in very clear, simple terms. Okay? If you go to the IRS website, there's also some information on this. I'm going to drop that in the chat as well. And let's take a look at, first of all, the definition of a trader before we even get to any sort of tax benefits that Section 475 has to offer. Let's understand what we're even talking about. In terms of the definition of traders, this is from the IRS website. Special rules apply if you're a trader in securities in the business of buying and selling securities for your own account. The law considers this to be a business, even though a trader doesn't maintain an inventory and doesn't have customers. To be engaged in a business as a trader of securities, you must meet all of the following conditions. You must seek to profit from daily price movements in the price of securities and not from dividends, interest, or capital appreciation. Your activity must be substantial, and you must carry on the activity with continuity and regularity. So these are some of the parameters that I outlined earlier. This should sound familiar. And the following facts and circumstances should be considered in determining if your activity is a securities trading business. First, typical holding periods for securities bought and sold, the frequency and dollar amount of your trades during the year, the extent to which you pursue the activity to produce income for a livelihood, and the amount of time you devote to the activity. If the nature of your trading activities doesn't qualify as a business, you're considered an investor and not a trader. So what does the mark-to-market election mean? Let's go back to the downsides that we talked about. The $3,000 deduction against other income that's not capital gains and losses, that goes away. All right, so now you have an unlimited deduction available in a particular year where you have losses. All right, so with that, it can be pretty powerful. Now you can deduct $50,000, $100,000, what have you. So that's important. Next item that you don't have to deal with as you make the mark-to-market election is the wash sale rule. That goes away as well. So the two downsides that we talked about that apply to investors completely are taken off the table. But it can't be all roses. What are the downsides, right? The downsides are that the mark-to-market election, as the name implies, at the end of each tax year, marks to market all of the securities that are in those trading accounts. So as of December 31st, let's say 2020, all of the positions that are held as of that date are going to be marked to market. That's marked up or marked down. And essentially, the income that you make under the mark-to-market election from trading is ordinary income, and all of the expenses are ordinary losses. All right, so all of these capital gain rules go out the window. Now, you might say, wait, if we're marking the securities held at year-end to market, how does that create a benefit? Because not only are we marking it to market, that's ordinary income. What gives? Well, if you think about it, active traders aren't really holding many positions overnight. So that would mean that, by definition, you are not having to adjust any significant amount as of that date. Because if you don't hold positions overnight, then that adjustment may very well be zero. But at the end of the day, all of the income that you make, all those gains that you realize throughout the year, those would be ordinary income. And you would have the expenses as deductible business expenses. So very powerful stuff in terms of allowing for more of those deductions that wouldn't ordinarily be available to simple investors. Another benefit of the mark-to-market election is the income that you're making is not subject to self-employment taxes. So you're able to reflect the income, you're able to take advantage of losses, and the expenses become deductible as well. Many benefits are applicable here, but it's important to keep in mind that there are some timing restrictions that are applicable to 475 that you need to keep in mind if you're looking to make the mark-to-market election. I've seen people burned on this as well. And if we look here, it says, a trader must make the mark-to-market election by the original due date, not including extensions, of the tax return for the year prior to the year for which the election becomes effective. You can make the election by attaching a statement either to your income tax return if filed without an extension or to a request for an extension of time to file your return. The statement should include the following, okay? So there's a list there that you can reference. And there are significant benefits to this election, and it's prudent in many cases to take a step back and say, hey, let's run a projection based on not having the election in place versus having the election in place and seeing what's more advantageous. It's also important to note that you have the ability to designate certain accounts as trading accounts and certain accounts as investment accounts. So you can bifurcate the treatments and have essentially some of your accounts marked to market and some of your accounts not, because you hold them for investment. You're not actively trading them. And you can change those designations on an annual basis as well. So there is some flexibility there. It's not all or nothing, and it's not that you have to consider all your accounts as trading or all your accounts as investment. There's a middle ground there. And ultimately, this is something that should be considered for individuals who intend to make a business out of trading securities, right? So to go back to the question that Jeffrey asked here, the deductions and credits are reasonable for starting a business that trades stocks. Let's see, you have the trading commissions, you have the research software, you have the charting software, you have any sort of other expenses that are ordinary and necessary for stock trading. That can include any sort of informational services, the fees you pay for streaming quotes, things like that. Everything could fall into that bucket, potentially. And those would constitute the expenses that you have to offset that income from the trading activities throughout a particular year. Now, if you structure this as a sole proprietorship, meaning that you are conducting this business on Schedule C, you didn't form a corporation, you didn't form a sort of a business entity to conduct the operation, then you would not be an employee. So you're not going to issue yourself a W-2. That's incorrect, okay? The income is going to be reflected on your personal income tax return. No need to file any sort of W-2 or anything like that. And if you're in the business of trading securities and you meet the requirements specified here, you do it with continuity, it's substantial, and you seek to profit from daily market movements, then the mark-to-market election may make a lot of sense for you. And you could also reference topic 429 from the IRS for additional information on that. This page is actually pretty clear in how it's spelled out. Everything is in layman's terms for the most part. It's pretty easy to digest. Hopefully, Jeffrey, this was helpful in shedding some light onto the mark-to-market election and the different tax treatments that are available to traders of securities. Now, actually, we have a question here. Let's check it out. This is from Jack. What's going on, Jack? Thanks for tuning in. And it says, I want to start an LLC and use the deduction for startup costs for 2020. I would like to find an individual or company that can offer a flat fee to start an LLC. I'm based in California. Well, unfortunately, Jack, I don't take part in the actual formation of entities. Reason being is that when you form business entities, it typically also entails including some sort of operating agreement, partnership agreement, things of that nature. And those aspects, at least from my understanding, constitute the practice of law. And if you have a operating agreement or a partnership agreement, even if it's a template, if you're providing that to a business to then be used, that can constitute practice of law. So I don't engage in that part of it. Where I start to help is that either a client has a plan on what they're looking to do and they want to understand the tax implications, not the legal implications, but the tax side. Then we help them in terms of planning and putting it all together. Aside from that, there's also individuals who already started their entity and they want to ask questions like, hey, does the S corporation election make sense? How can I structure things to be advantageous from a tax perspective and so forth? And that's where we get involved. So as far as your search for the perfect entity to start a business, I always advise clients to work with an attorney because limited liability and all those other things are not really top of mind until and unless things hit the fan. Right? So limited liability is one of those things where we don't really think about it too much until it becomes a problem, until there's a lawsuit, until someone slips and falls, something of that nature, and then it becomes a huge issue. So that's why I like to stay away from that altogether, leave that to the attorneys. That's their area, and I handle the tax side of things. So unfortunately, I wouldn't be able to direct you at all there. Now it says, I've used 401k and IRA income and used those proceeds to invest. Are those tax deductions that are available? So typically, if you're investing in securities through your 401k and IRA accounts, if it's happening within those accounts, there are no current tax benefits available because essentially you receive the deduction when you make the contribution to those accounts. And when those accounts are distributed out, you're going to pay taxes on them. But in the interim, there are no immediate tax implications. Now, if you're saying that you distributed out your 401k or IRA funds to start the business, that would have to be analyzed separately. So the distribution of those amounts you'd have to see if you're subject to any sort of early distribution penalties, what the tax implications are of that. And separately, you make a determination just by looking at the business side, whether you have startup expenses or expenses that are just not deductible, what needs to be expensed, what needs to be capitalized. So it is two separate transactions, and you have to analyze it as such. And that's going to guide you in terms of understanding from the business side what is doable. Because even if you have, let's say, $100,000 in startup expenses, in some cases you're able to capitalize those and deduct them over time. So it's not that you're getting an immediate deduction, but you can capitalize and take a deduction over a number of years. Either way, if you can deduct it or not, it's important to understand the amounts that are applicable and their classification so that once you start the business, you don't miss out on deductions that may have been available if you had a more careful overview of all those different expenses. So to sum it up, if you had expenses in your 401k or IRA accounts, typically those are investment-related expenses. Unfortunately, no current deduction is available. But if you're talking about amounts that you distributed out of your 401k and your IRA, you have to analyze that separately. And then whatever business you're applying it to, you have to have an assessment of what's capitalized, what's expensed, what's a startup expense, what's an organizational expense, and so forth. And this is where CPAs are very helpful because we can help you go through all these expenses, classify everything out, and make sure that the tax treatment is proper. I've seen way too many businesses that start in their first year, they have no income, but $800,000 in losses. That's bad news bears, and in many cases is incorrect. So stay away from trouble in this area. It's very easy for the IRS to pick this apart and other taxing authorities. So I'll just advise you to work with the CPA, understand the implications of both the distributions from your retirement accounts and any subsequent investment you made with those, whether it's starting a business or not, and seeing what tax benefits may be available. So thank you so much. Appreciate your questions here. And if you guys have any additional questions, feel free to drop them in the comments below, and I'll go ahead and answer them if it's compelling enough. Have a good one.